Welcome, my dear student. This is a very important topic, which is the financial ratios. We know always that the managerial accounting and the accounting in general is feeding the management with numbers, and these numbers is always helping the management as indicators for taking decisions or decision making. We actually have something we call it here the ratios or the ratios analysis. Is very important, this topic, because it can show the company the outstanding and its situation in regarding when it's compared with other competitors or other companies who are working in the market. Through this, we can know the return on investments. We have many financial ratios, and all is very important for the decision maker, like I said. So the first one of them is the return on investment, which is known with the word ROI. This is very important. ROI. So what is the ROI? The ROI is the net profits after taxes, of course, divided by the shareholders fund. So if I give you as example, the net profit was 70 and the shareholders funds was 1,000, then you will divide 70 by 1,000. It will give you 7%. It's very easy. It's only one formula, a nomination and denomination, a ratio, and you will apply it. That's it. Okay. How it's useful in when you compare between two companies' activities and performance financially, you always check the ROI, return on investments. Okay, you will choose the one to buy the stocks. You will buy the stocks of the company in which the ROI is greater or higher. So if there are two companies, the ROI for the first one is 10% and the ROI for the second company is 15%, then you will prefer to invest your money in the company which the ROI is greater, which is 15%. Now, let me go to other very important also. One of the very important ratios, which is the operating profit divided by sales. So it is when you see any ratio from the name itself, like operating profit divided by sales, then on the nomination there will be the profits, and in the denomination will be the sales. From the name itself of the ratio. So you will not be like have to memorize it and this and that. You can deduct it by only with the common sense. So here, the profit, let's say the profit before interest and taxes was 100,000 and the sales was 2,000. So that means that the profit divided by sales ratio will be 100 divided by 2,000 will be 5%. Okay. We have also the gross profit. So what is the difference between the operating profit and gross profit? We said this before when we were talking about the income taxes. We said that the operating profit is the profit before taxes or the profits before taxes, but the gross profit, sorry, the operating profit is before taxes. The gross profits is the profits when you deduct the cost of goods sold. We call it gross profit. Okay. So you will say the gross profit, you will get it from the income statement. It is 500. You will divide it by the sales, the total sales, not the expected sales. If I give you total sales, 3,000, 2,000, total sales, 2,000, and expected sales, 3,000, forget about the expected, because based on the accounting principles, we calculate what really happened, the actual sales, not the expected or promised sales. No, we calculate the actual sales. So here we'll divide the gross profit divided by, again, I'm saying with the common sense, it is gross profit divided by sales. Here, gross profit divided by the sales. So it is 25%. What is useful? What is it useful for? To compare between the performance of two companies. If one company, as example, is given 25% and the other company is given 15%, then the company with gross profit divided by sales 25 is greater than the one with 15. So that means you will invest your money on the one which is giving, for the one which is giving 25%. That will be fine. Yeah. How about the liquidity ratios? What do we mean by the liquidity? Liquidity means the ability to change the assets, the ability to change the assets into cash. The quick the assets can change into cash. We call it the liquidity. From liquid means how to liquidize your inventory, your stock, whatever, into cash. Okay. What is the liquidity ratio? The working capital, the first one is the working capital ratio. The working capital ratio is the current assets divided by the current liabilities. So all the current assets divided by the current liabilities. So if I say that my current assets were $500 as example, and the current liabilities were 350. The current assets on the side of the assets in the balance sheet, and the current liabilities are on the side of the liabilities on the balance sheet, the current. So I will divide them by each other. This is called liquidity ratio. The first one of those ratios, we have many ratios. First one is called working capital, like you see here. So it is 143%. Okay. How about we have also another liquidity ratio that like the asset test. We call it asset test or quick ratio. It's the same like this one, but what we will do here, we will deduct the inventory from the nomination. So it will be current assets like here, but minus the inventory. So if I give you in the example that you have current assets of $500 and you have inventory of $200, then you will deduct the inventory, because sometimes the inventory is not quick to change into cash. The inventory might stay long last before switching into cash. So it's not fair then to calculate the liquidity ratio with inventory included. For that reason, we avoid or remove the inventory by deducting it to find the quick ratio or the asset ratio, okay, or the asset test. In all the cases, it is assets minus the inventory divided by the liabilities which you have. Also, we have here interest cover. This shows the ability of the company to pay its credits. The ability of the company means the ability of the company to pay its credits. As example, if I owe you money, I have a strong willingness and a good performance to the limit that I can cover my expenses and my money due, which I have to pay for you or no. Okay, how many times I can cover and how many times I can pay you what I owe you, what I have to pay for you. How many times I can pay for you what I have to pay for you. This is the meaning of the interest cover. How many times I can cover myself as a company. How many times I can cover myself. How many times I can cover myself without going for bankruptcy. This is the meaning. So it is profit before interest and taxes. Okay. Profit before interest and taxes divided by the interest payable. So you will get the interest payable 16 and the profits was 100 as example. So you will divide 100 by 16, 6.25. It means that you can cover yourself 6.25 times. Okay, means by other way that your assets can cover your liabilities 6.25 times. Okay, you can pay, what you have to pay to the people 6 times, not only one time. You can pay for them 6 times, so you have enough amount of money. That's very satisfactory. How about the activities ratios? The activities ratios is it shows how far you are moving and fast responding to the market and very good, and your performance in the market. How in general your performance in the market, in the production, in the marketing, and all the activities, business activities. How far you are moving. Okay. So the first one is the assets turnover. This will be the sales divided by the total assets. So if the sales are 2,000 and the total assets are both the assets, current assets, and fixed assets, all of them were this amount, 1,150 plus 500. So I will divide 2,000 by 1,650. That will give me 121%. One of them also is very important is the earning per share. Earning per share. I mean, for each, the earning per share. So it will be the profit taxes, profit after taxes, divide by number of shares. How many dividends or how many shares you have, the stocks. Share mean the stocks, okay? So the profits we have is 70,000. And we have the number of stocks is 100,000. So it will be, I will divide 70 cents for each stock. That means I will divide 70 cents for each stock. So we talk about the kinds of ratios, the financial ratios here. Thank you so much.